When you hear about national debt, the headlines can sound terrifying. Trillions of dollars owed, mounting deficits, and governments borrowing at record levels. But is the situation really as unsustainable as it seems? Well, no, because debt trajectory is often more sustainable than headline figures suggest. Here's why. First, economists don't just look at raw debt numbers. They measure debt-to-GDP ratio, the size of the debt compared to the size of the economy. If GDP grows faster than debt, then the trajectory becomes more manageable, even if the total debt keeps rising. Second, interest rates matter. When borrowing costs are low, governments can service larger debts without straining their budgets. For example, in the past decade, many advanced economies expanded their debt while keeping interest payments historically low. Third, inflation and growth dynamics help reduce debt burdens over time. A growing economy increases tax revenues, which governments can use to stabilize or reduce debt ratios. Moderate inflation also erodes the real value of existing debt. Fourth, structural reforms and investment can make debt more productive. Borrowing to fund infrastructure, education, or technology often yields higher economic growth, making the debt easier to sustain. This doesn't mean that debt doesn't matter. It does. Poorly managed borrowing, high interest rates, or political instability can quickly flip the trajectory. But in many cases, debt is a tool, not just a burden. The sustainability depends less on the number you see in headlines and more on the underlying economic fundamentals.